this video, we will be seeing about what is investment, why should one invest, and when to start investing, what is meant by interest, and what are all the factors that determine the interest rate, and the various options available for the investment. So, the money you earn is partly spent, and the rest is saved for meeting future expenses. Instead of keeping the savings idle, you might like to use your savings in order to get some return on investment, okay, in the future, some return in the future, and this is called investment. So the money which we are supposed to save, if it is invested fruitfully and also it is going to some return in the future, then it is investment. So why should one invest? Okay, that's a good question, right? So why should one invest? So first of all, one needs to invest to get some return on some idle resources, and also to generate a specified sum of money for specific goals in life, okay, and also to make a provision for uncertain future. We don't know what is going to happen in the future, right? So for okay, getting some return on the idle resources, and for getting some specified sum of money in the future, and also to make some provision for the uncertainty in the future. And another major reason why one invest, okay, is because of the cost of inflation, okay. So we know that inflation is the rate at which the cost of living increases. The cost of living is simply what it costs to buy the goods and services you need to live. So inflation causes the money to lose value. So if I have money and if I'm keeping it idle, there is no point, because the money that I actually saved will be lesser in value in the future. So to avoid this type of loss due to the time passage, we actually invest, right? And that is one of the reason why we should invest. So let's say, like for example, there was a 6% inflation rate for the next, okay, 20 years. Rupees 100, okay, of today, what it could purchase could cost rupees 321 if we do compounding, okay, if the interest is payable annually. This is the reason why it is important to consider inflation as a important factor in doing any investment, particularly the long-term investment. The aim of the investment should be to provide a return which is above the inflation rate. So the return should be, our return rate should be above the, okay, inflation rate. That's the important one. The For example, if the annual inflation rate is 6 percentage, okay, the inflation rate is 6 percentage, then the investment will need to earn more than 6 percentage to ensure it increases in value. Okay, if it is less than 6 percentage, that is after tax money, after your okay, when you're going to retrieve after your maturity period in the investment is less than 6 percentage, then obviously your asset has actually decreased in value. That is also not a good investment. So here there is, okay, two prong, okay, approach. One is to determine a investment which actually gives a rate of return higher than the inflation rate, okay, and if it is less, then it is better to look into some other, okay, strategy or some other means to do investment. So next important question is when to start investing, when I should start investing. The sooner one starts investing, the better. And also, I would say, invest regularly, invest early, invest regularly, and also invest for long term and not for short term, because the benefits will be much more in the long term than in the short term. Now let's go to the interest part. So now we are actually seeing, okay, that some interest rate were specified, and we were saying that this interest rate in the rate of return should be greater than the interest rate of the inflation. So what is this interest? When we borrow money, usually we are expected to pay for it. This is known as interest, simply put. So interest is the amount charged to the borrower, right, for the privilege of using the lender's money. This interest is usually calculated as a percentage of the principal balance. If let's say like 100 rupees is there, and if you're saying 10 percentage is the interest rate, if this is the principal, on this only this interest rate will be charged. So rupees 10 will be the interest for let's say 1 year. So what are all the factors that determines this interest rate? That's very important, right? So the interest rate factors. When we talk of the most important factors, they're mostly okay economy related. Some of these factors are demand for money. Okay, how much demand for the demand for money? More the demand for money for the economy, and according to the interest rate will be fixed. Level of government borrowings. Okay, and another one is supply of money. How much money is there in the economy? If the supply of money is more in the economy, then the inflation will be happening. So government has to reduce the supply by increasing the interest rate. So these are all the factors that in fact determines inflation, and obviously last but not the least we can also say the inflation rate. So now that we have seen about interest and not all the factors that determines the rate, let's see about the various options available for the investment. So one can invest in two things. One is the physical asset, another one is the financial asset. So what are physical assets? Physical assets are usually gold, it may be even jewelry or land, even commodities. These are like physical assets. Whereas financial assets usually includes the fixed deposits that we have in the banks. So fixed deposits in the banks, small savings, and even post office savings, and then the insurance, pension, and so on we have. So these are like financial assets. So what are all the various short-term options available for the investments? So if you take okay financial any type of investment, it can be again okay divided into two types: short-term and okay long-term. So what are all the things that is available under the short-term? So if we take short-term, in the case of financial assets, we have savings bank account. This is one of the widely used way of okay investment, and this is for the people who are having less risk appetite. So it usually gives interest to the rate of range of around okay 4 to 5% per annum. And then we have something called money market or liquid funds. What is this money market or liquid funds? So a specialized form of mutual funds that invests in extremely short term fixed income instruments and thereby providing easy liquidity. That means like it's what is that? It's a special form of mutual funds. That's what we have to remember. It usually okay invests in extremely short-term fixed income instruments and thereby giving us easy liquidity. They are mostly oriented towards protecting your capital, and therefore their main aim is to maximize the returns. So their okay rate of interest will be obviously better than or higher than the savings bank okay interest. And one more thing that we can see under the short-term interest is the fixed deposit in the banks. So the fixed deposits of the bank or referred to as term deposits, and the minimum investment period in this case of fixed deposit is 30 days, and the fixed deposits are for the investors with low risk appetite and may be considered for maybe even 6 to 12 months. Okay, and then this fixed deposits however okay they give more okay interest rate comparatively that of the savings bank as well as the money market. Okay, now let's see about the some of the important long-term financial options available for the investments. The first one I would say is the post office savings. So usually the post office monthly income scheme is a low risk saving instrument which can be availed through any post office. It provides an interest rate of around 8% per annum, which is paid monthly. The usually okay but however the minimum amount which can be invested in the case of the post office is 1000 rupees or any additional investment in multiples of thousand. Okay, and also the maximum amount that we could actually put in the post office is around 3 lakhs if it is individual, or it would be 6 lakhs if it is okay joint. So this is something okay we should remember in the case of post office savings. And if it has a maturity period of 6 years, so it is not like we can have our savings in the post office infinitely. We should have to take the amount up to the period of 6 years. However, premature withdrawal is permitted in the case of post office savings. The deposit is more than 1 year old only. Okay, so after 1 year of putting your money in the post office savings, you are entitled to take your deposit. However, if you are if you are ready to take, or if you want to take your money before 1 year, then you have to pay a penalty of 5 percentage okay deduction in the interest rate. So next long-term savings that we are going to see is PPF, Public Provident Fund. So it's a long-term savings instrument with a maturity of 15 years, and the interest payable at 8 percentage per annum. Again, okay, it is more or less comparatively same as that of the post office savings. A PPF account can be opened through a nationalized bank at any time during the year, and it is open all throughout the year for depositing the money. The tax benefits, okay, can be availed for the amount invested and interest accrued. Okay, invested and also the interest accrued is also tax free. This is okay one of the important features. A withdrawal is permissible every year, but it starts from the seventh year onwards. And however, the maximum amount that you can withdraw from the seventh year is only 50 percentage. And let's see the next form of the long-term savings. This is the company okay fixed deposits. So company fixed deposits, these are actually short-term to medium-term. There are two varieties obviously available. Okay, so however, most of the company deposits are of okay medium term, that is 3 to 5 years. Okay, so again, their interest rate is better than the fixed deposits offered by the banks, and also it is mostly long. And then we have something called bonds. So this is a fixed income instrument used for a period of more than 1 year with the purpose of raising capital. Okay. Usually the central government and the state government and the corporations and the other similar institutions sell bonds. Whereas if the company sells okay the similar kind of instrument, it is called debentures. That is the terminology being used in India, but however no, there is no fundamental difference between the terms bonds or debentures. A bond is generally a promise to repay the principal along with a fixed rate of interest on a specified date called the maturity date. So the next one we are going to see is the mutual funds. So mutual funds, these are the funds operated by the investment company which raises money from the public and invests in a group of assets. So it raises the money and then it invests that money in a group of assets. Assets are usually securities or debentures, or even it could be um, company bonds or government bonds. So people who don't have that knowledge or technical skill of investing alone or single-handed in the stock market can take support through this mutual funds. There, okay, return on investment is far better compared to the four okay options which I discussed under the long-term options for investment. So in accordance with the stated set of objectives, okay, this company invests money. It is a substitute for those who are unable to invest. Okay, as I said, uh, benefits includes professional money management, buying in small amounts, and diversification. Mutual funds are issued and redeemed by the fund management company based on the fund's net asset value, which is determined at the end of the each trading session. The net asset value is calculated as the value of all the shares held by the fund minus the expenses divided by the number of units issued. Mutual funds are usually long-term investment, as I told, and they are actually there are some categories of mutual funds such as money market mutual funds, which are short-term instruments, but mostly it is long-term. So Now that we have seen about these things, let's talk about some basic okay terms like what is equity, what is share, all those things. Okay, so what is equity? Total equity capital of a company is divided into okay equal units, and each unit is called a share. Okay, and for example, if you take a company as a total equity capital of let's say 2 crores, okay, it is divided into let's say um, again okay another 2 crore units, then each unit value is 1 rupees, right? 1 unit value is equal to 1 rupees, and that is a share. Thus the company then it is let's say like the company is then said to have around 2 crore equity shares of rupees 1 each. Notice of such shares are the members of the company, and they have voting rights. If you have this thing, then you have voting rights. The more you have, the more you power. Next, let's see what is the debt instrument. So, debt instrument represents a contract whereby one party lends money to another on payment terms with regards to rate and the periodicity of interest, repayment of the principal amount, all those things. In Indian securities market, the term, as I said, right, the bond is used for debt instruments by the central and the state government or any other public sector administrations. Whereas the debenture is used for the corporate sectors, and the same debt instrument is issued by the companies, then it is called particularly private companies, then corporates, then it is called debentures. Now, um, let's talk a little bit further about mutual fund, which we already discussed under the long-term options of investment. So, what is this mutual funds? It is a body, first of all. It is registered with SCBI. That's very important. Securities Exchange of India. That pulls money. Okay, it pulls money from the investors. Mostly, okay, investors are like individuals like the company, or it can be even corporates. So it pulls money from them and invests this money in some financial instruments. Could be whatever instrument that we saw under long term, or it can be short term instruments. It depends. So so mostly the instruments would be like securities such as equity shares, government securities, bonds, debentures. So it can be considered as a financial intermediaries, right? Because see, it is getting the money, and then there is some body called mutual fund, which is again doing okay investment on the equity shares. If directly do then do this okay so, intermediary, then we are actually exposed to risk. But since this intermediary is like is usually composed of knowledgeable persons who have a good amount of experience in handling these security instruments or investing in the security instruments. So that is one of the reason why people prefer this intermediary such as mutual funds. You have to just okay, give the money to them, and they will take care of you know investing in a risk investing in a instrument according to your risk appetite, and thereby you get the returns. So the appreciation of the portfolio of securities in which the mutual fund has invested, the money leads to an appreciation in the value by the investors. So the investment objectives are defined with the mutual fund in its prospectus or usually binding on the mutual funds. The investment objectives usually is, as I said, right? So let's say like you actually want to invest in a risky, okay, let's say securities, wherein the return will be high, risk high, return high, right? So usually it would be mentioned in the investment objectives of the mutual fund. So the mutual funds actually they, as I said, they will invest in equities, bonds, debentures, commercial paper, and government securities. The schemes offered by the mutual funds varies from fund to fund. Some are pure equity schemes. Let's say like in this same okay the agreement you are signing, once you are enrolling yourself in the mutual fund, there it would say you can choose your risk invest, whether it should be a risky one or more risky one or less risky one. But at the same time, we can also say um, what sort of instruments you want your money to get invested. It can say like it should be completely equity shares, or you can say it can be a mix of equity and debt. So investors are also given the option of getting the dividends. That's another important. Okay, obviously because these intermediaries are in fact investing in equities. If you are investing in let's say like pure equity based mutual funds, then you are entitled to get dividends. So those dividends obviously would get um, that's what I can say as far as mutual funds is concerned. And there is something called index, right? What is this index? Index shows how a specified portfolio of share prices are moving in order to give an indication of the market trends. We have okay, FMCG index, which comprises some few FMCG companies under its portfolio. If the FMCG let's say like if the FMCG companies perform well, the FMCG index also performs well. That's why a specific portfolio of share prices are moving in order to give an indication of the market trends. It is, as I said, it's a basket of securities, and the average price movement of the basket of securities indicates the index. Now we have something called depository. What is this depository? So depository is like a bank. Okay, in a bank we have some bank account. It is similarly wherein you store money. In a similar way, in the case of equity markets or securities market, wherein we will deal with equities, share, whether it's equities or shares or bonds, debentures, or whatever it is. Those things will acquire and we will store it in electronic form. Okay, these things will be like an electronic certificate. The deposit of these electronic forms of debentures, bonds are called depository. So depository is a place wherein electronic form of equities, debentures, and other common securities will be deposited. Now we have something called dematerialization. It's very simple. Okay, so materialization is like something we cannot realize. Dematerialization is not realizable, so converting it to virtual form. So what is getting okay converted to virtual form? Obviously, initial days we used to have share certificates, right, which is actually printed on a paper. Nowadays it is actually otherwise. All these are being converted into electronic certificates, e-certificates you will be getting. So this process of converting a physical certificate to equivalent number of securities in electronic form is called dematerialization. Once it is converted to electronic form, then it will be deposited. Okay, if it is money in the case of bank, it will be deposited under the account number. But in the case of um, this share market, all this okay e-certificate or electronic form are stored in the depository stored, but we instead of account number we call depository participant. This is a number actually. So usually a repository contains electronic forms of certificates of equities and bonds. And the process of converting a physical to electronic form is called dematerialization. Once we do dematerialization, obviously how to determine like which electronic certificate belongs to who, then that is done through depository participants. So that's it as far as this video is concerned. So meet you in the next.